let's get more on how we navigate these markets with Robert Luna, CEO and Chief Investment Strategist at SureVest, joins us from LA, Los Angeles. Rob, thanks for your time. If the S&P 500 is 45 points or so away from a bear market, do you get in at these levels, or do you bide your time and keep your powder dry?
You know, look, if you're looking to get into the S&P 500, I say you probably wait. I mean, more than likely we will hit that bear market. How deep we go into that, is anybody's guess, I think. But the challenge is when I'm looking at the broad-based indexes, they're not really telling the story, whether that's the NASDAQ, the S&P 500, the Dow. The amount of carnage that's been done, as you know, within those indexes, many stocks down 60, 70% from their highs. Look at some of the ARC portfolio types of names of Cathie Woods down 70 and 80%. So I think if you're looking at the index, why I believe there's still some more damage to be done is it really wasn't until this week where we started to see the consumer staples, the energy names, the utilities, the names that everybody's been hiding out in and have really done quite well so far year to date. Those are the ones that really started to take it on the chin. And that's really traditionally what you need to see in a bottoming process, is the stocks that were the last safe haven really starting to give it up. And I think you're starting to see that now. And in my view, that makes a lot of sense.
Yeah, the generals are under attack, aren't they? And that's concerning. Can we get to this retail apocalypse, Rob? Retail and consumer staples, some high quality companies really got thrown out this week. Was that way overdone, or is that an appropriate reaction, an appropriate repricing given the margin compression?
Yeah, I think you're seeing a few things. As you mentioned, you're having margin compression as the 10-year has gone up. So what people are willing to pay in terms of that multiple is coming back down. We saw that across the board. Let's remember some of those names like Target, Walmart, they've held up pretty well. So a lot of people that have profits in them were definitely going to take it. But look, we are in a bear market, let alone if the S&P says we're 19%, we are definitely square, don't mistake it, in the middle of a bear market. And what happens in the bear market, if you miss earnings, it's going to be magnified significantly. We've seen that in Target. I think that name is starting to get a little bit overdone, probably Walmart now, but that's what happens in bear markets. Nothing stops at the point of parity. It will go down below that. And until that momentum stops, you won't see any stabilization in those names.
Hey, Bob, Martin here. Great to see you again. I appreciate your time, as always. So I get your point. I mean, timing this thing is almost impossible. Nobody's going to be able to do it. So a better cost average in with the losers and not the winners. Right now, you're looking at huge names, Google, Meta, Amazon, and you're thinking pretty good value, right?
Yeah, I mean, absolutely. If you start looking at some of the names, let's take Meta out of those three, for example, it's actually trading cheaper than Kellogg, trading cheaper than Coca-Cola. And we all know more than likely over the next 5 to 10 years, their earnings are going to be growing much faster than those companies. But everybody right now is afraid to be in those names. But you all know over a long period of time, you absolutely have to go where people are scared, where people are nervous, because this will not last forever. And I do think, one thing I was looking at today, Bank of America has been doing a study of money managers. More money managers have more money on the sideline today than they did in 2001. Also, like I said, you're going to see a rotation out of those safety names. That's going to create even more cash. The place I believe it's going to be going is in technology. Look at that today. The markets were down, as we said, but the names that have been getting real beaten up, the ARC names, the ARC ETF up 5%. If you look into there, the Teladocs, Ubers, Shopify up double-digit percentages, and that's not being reflected in the major indexes. That's why I think that's where you have to put your money now.
Bob, these names, are they recession-proof? Should we trip into a recession?
Well, look, I think where the valuations are now on Facebook, on Google, now Amazon starting to get there, it's not necessarily about recession proof. I think it's about balance sheets, which these balance sheets are very, very stable. It's about price, and the price has been significantly discounted. Where you would normally going into recession, those names are overvalued. You're trading at a higher value than the S&P, higher value than growth. So the playbook of now thinking we're going to go into recession, which who knows, we may already be. First quarter negative GDP, who knows what's going to happen in the second quarter. You're a little bit late for that game. At this point in time, you have to be putting money. Again, it could be volatile. You could see another leg down. But in the names that have underperformed, I think these three companies are a safe place right now if you're starting to average in.
Rob, spike in consumer credit, the housing market is slowing down, and then, of course, you got the negative wealth effect from this meltdown, that's been evolving in the stock market. Where does that leave the consumer? And is there a tipping point where the consumer really starts to roll over, and where then does it leave the cyclicals like energy?
Well, I mean, look, I think the good thing is that still, if you look at unemployment rates, they're still very low. If people want to work, there's still jobs out there for them. Inflation has combated a lot of what we've seen in wage increases, so those have actually been negative. To your point, though, you mentioned the wealth effect. I think that's probably one of the biggest things. A lot of this damage has actually been done within this month. People haven't gotten their statements. They're not necessarily like you and I staring this at a day-to-day basis. I think that is going to change some behavior. Some of the things you talked about, leading indicators, we're already seeing in the higher end of housing. Homes are starting to sit a little bit longer on the market. I've talked to some major realtors out here in the Los Angeles, Newport Beach type of area, to where they've had people backing away. So look, psychology is going to lead the market, but remember, the market is a leading indicator. If you look at technology, that started declining way back last year. The question is, when is a lot of that going to be priced in? I think we've seen that in some of the names I'm talking about maybe going into, but I do think some of the cyclicals, to your point, like energy, that's an area I would not be adding new capital. If I had profits, I'd be taking some of those profits right now.
All right, noted. Listen, Bob, great to talk to you. Great value as always. Thank you for your time. Appreciate it. You keep safe. We'll do it again soon. Bob Luna there from SureVest joining us live.